All three indices getting a boost from Nvidia on the back of its earnings. Take a look at Nvidia. Shares up just about 5% right now. For more on the trading day ahead, let's bring in David Bahnsen, Chief Investment Officer at the Bahnsen Group with $8.5 billion in assets under management. Good morning. Good to see you.
Well, good morning. Good to be with you.
All right. Everybody's got to get asked this question today, David. Nvidia report. Does it ease concerns about a bubble? And also, does it make other parts of the tech landscape more attractive, less attractive? How do you see the whole picture?
It doesn't at all for us. I mean, I think the biggest part of the bubble for me is not he who is receiving the money, which is Nvidia. It's those who are paying the money, which are the hyperscalers who have seen their CapEx level go to just stratospheric levels. And I think that's the bigger problem. I would point out, too, that even with Nvidia popping here this morning, it's nowhere near where it was a few weeks ago. And if it doesn't make a new high on news like what came yesterday, I think you could argue, I'm no technician, but I don't think that ends up being a positive. Nvidia's raking in the money right now. There's no question about it. But I think it's more the expenditure side than the income side that matters.
Okay. It sounds like you may be keying on something I don't think anybody else really is, maybe a few people, the idea that Jensen Huang said there's just no assurances when it comes to OpenAI and these other deals. So you're saying you're worried about their ability to generate the revenue to pay Nvidia?
It's not that I'm worried about their ability to generate revenue to pay Nvidia. They're going to pay Nvidia. These companies have EBITDA and cash flow. I'm worried about the ROI on those expenditures. I don't think that any of the hyperscalers have any idea what the ROI is, and that's fine to a certain degree, but not now at $1.5 trillion of 5-year, 6-year pro forma commitments. I mean, this is bubble-like behavior. There's no question about it.
Okay, you're seeing potential bubbles. Very interesting, because this morning you may be the only one. Everybody else seems to be pretty bullish on everything.
It's not the first time I've been out of consensus.
Understood. There's nothing wrong being a contrarian. Your word of the day is reasonable. So what's reasonable? Because it seems like you think some people are showing some irrational exuberance this morning. What is reasonable?
Well, look, I mean, we are fundamental-oriented investors, and when you're dividend growth-driven, reasonable is often connected to cash flow and growth of cash flow. And that's one of the things that made a lot of those big tech companies so wildly profitable and huge stock price returns was that they were capital light, so they didn't have to reinvest a lot of cash flow. Now, all of a sudden, there's this massive AI CapEx commitment. I really do like companies that are in a free cash flow position to return a lot to shareholders and reward us and de-risk our investments. It's a reasonable way. It's not the only way, but it's a reasonable way to generate handsome profits in a risk-adjusted way for investors.
So that leads me to your pick. You're moving, well, I don't know if you're directly moving away from the AI trade, but certainly not playing it directly. It's Chevron. So is that focused on the idea that the dividends, of course, but that we're going to need energy to power all this? Is this like a second, third derivative play in your mind, or is it simply a dividend and you see a rebound in the oil market?
It's funny. You're wise to point out that there is a derivative play, whether it's third, fourth, fifth derivative, I don't know. But if there was no such thing as AI and no such thing as data centers, Chevron would be the pick right now. But you are right that there is a significant amount of power generation that has to come from natural gas, and Chevron is very much involved in that out of the Permian Basin in particular. But no, the basis of the pick here is a 5% dividend yield that's growing high single digits, where they're making money hand over fist at $60 oil. They'll still make money at $50, and you could very well get back to $70 oil. So Chevron's just behaved very well. It's a durable pick. And back to that word of the day, reasonable. Investors in Chevron have been treated very reasonably for a long time.
All right, the reasonable David Bahnsen. Great to see you. Thank you very much.
Thanks so much, Frank.